Oh, that's what I was thinking. I thought there was silence there, and I thought, should I be speaking or should I not be speaking?
No.
That's what I'm thinking. Okay, I'll keep my mouth shut.
We are just waiting.
That'll be a minor miracle, Bobby, but yes, I think we're live on Facebook. So over to you, Simon.
We're good to go. Right, good afternoon, everybody. Welcome to our last Thursday edition at 2 p.m. of the Property Professional Show. As you know, if you were following last week, we're going to be in the show till 5 p.m, as it says behind my co-host there, Dill. Say hi, Dill.
Hi, Dill.
Brilliant. So Dill is, you well, Dill? You're still looking a bit green. I think you're okay?
It's all this gamma radiation. Too much zooming, I think, that does it.
Is it? Okay, cool. Try and get some lead somewhere in the system there then to block that out.
I'm going to have to find a pencil though.
Have a collection of pencils across your desk. Anyway, so good afternoon to everybody and welcome to our attendees today. So joining us live on the Zoom meeting, which is always great to have the people here, and also all our visitors on Facebook, either watching live or on catch up. So maybe good evening to you as well. What do the property professionals do? Like-minded bunch of individuals from all walks of life in property, covering many angles, and just offering opinions, services for people to explore, network, share ideas, try and avoid the need to just go on those expensive courses unless you really want to go on one. It's not what we try and do here. We try and give you a lot of education for you to share and network, grow your own business portfolio, whatever you're trying to do, get some tips, ideas from our fellow professionals that we work with. Delighted to see our usual panel of experts joining us. So we have the Chancellor. Say good afternoon, Bobby, if he's there.
Good afternoon.
Good afternoon. So Bobby will give us his fantastic update on the financial markets in a few minutes, and we have Ranjit joining us from Property Investor News. So if you can see he's there, say hi, Ranjit. There he is. Give us a wave. So as everyone knows who's involved in property, if you don't subscribe to Property Investor News, then you have to wonder why. Really, it's $7.95, and unless he's changed the offer, it's 6 months free. So maybe he has changed the offer, so I shouldn't say that. I should wait for him to do his speech. But fantastic magazine full of advice and recommendations in there from even some of our own panel, isn't there, Dill? So who did a presentation in the magazine in January. So so that's us. We're a non-profit making organisation. We're not here to sell you anything. We're here to network, learn, share ideas and develop our own businesses. So without further ado, we also need to introduce our guest speaker, Arif Punjani, who'll be giving us a detailed look at taxation on portfolios. He is a registered chartered accountant with more qualifications after his name than you can shake a stick at, because it's just endless amounts. I don't know how the guy did any work. He's got too many qualifications after his name, but he is an expert in his property field. So we'll welcome him to join us at the end as our main speaker today. So let's go on with the show, and let's go over, last point before we go with the show, questions and answers are going to be at the end for all of our guests. So questions for Bobby, Arif, or just in general around property professionals, all at the end, with my co-host Dill, who will be in the chair to take all those questions. So please fire them in either on Facebook or on the Zoom chat in the Q&A box. So afternoon, Bobby, how are you?
Very well, getting much better and glad to be here as always. So thank you for having me, Simon.
Our resident chancellor, bit busy this week in the news, I see.
Yeah,
So
very busy. Things have been really going well.
We talk about development loans for
development finance. I think the biggest topic of now is actually 95% lending. So as we actually know, sorry,
that was my attempt at humour, Bobby. Development loan of a flat where you work at number 11. You see,
number 11. Well, not quite. At the moment, number 10 is going through a lot of scrutiny for expenses at the moment.
So perhaps we need to have a chat about how to evidence your paperwork correctly.
Maybe so.
Over to you. Please give us the financial updates.
Thank you very much. And just to actually advise everyone, this is just really my view of how the financial markets are looking, and by no means advice in any way or form. But as always, I'm always talking about interest rates. I did say at the start of the year, I do see interest rates falling, but not a huge amount. And I probably still stand by that. But the biggest surprise is 95% rates have actually come beaming into the market. 95% rates are already falling within a month of them coming into the market. But I would say a lot of expert borrowers, a lot of lenders are actually saying they're actually considering saving more money for a 90% because of the difference in mortgage interest rates. But compared to last week, or compared to a couple of weeks ago, where I was quite pleased to say there were over 30 deals in April for 95%, I'm even happier to say there are over 100 deals now available at 95%. And these are both help to buy and non-help to buy. But competitions from UK's biggest banks as they began launching 5-year deposit, 5% deposit deals from mid-April with the backing of the government's mortgage guarantee scheme it's actually driven the average 2- and 5-year fixed rates by down 0.45%. And 0.15% respectively. So in effect, the 90% rates have had to come down as well, which is actually quite good. As we all know, Rishi Sunak actually announced a 95% mortgage guarantee scheme in the budget on the 3rd of March. But lenders using to pay a fee in return to the government agreed to cover significant proportions against any losses a lender may occur if the property is repossessed. But I would still say, as we all know, 95% mortgages, if they're help to buy in brand new properties, they will be slightly higher than the average property. So see if you can actually go ahead and communicate with lenders, your brokers, and see if you can get a regular property that's slightly older, maybe needs a bit of work, something with a lower lease or something. There are so many deals out there. But one of the main things I've actually seen this week is a lot of buy-to-let investors, and I would say that from my personal portfolio of clients, they're diversifying into development finance. And the number of inquiries have probably quadrupled in the last couple of weeks from myself. And these are people with no experience in any way or form in development finance, but we're actually going to need to cover a fundamental hurdle standing in the way, which is the shortage of housing stock. This has been acknowledged in recent years, and governments have introduced several changes to planning legislation, making it easier for developers to deliver more residential property. But in response to new opportunities, I've seen the arrival of new developers. Often, what people don't actually realize, even a renovation of an old building is still considered help to buy approved. We've actually done a number of properties in London where clients have actually developed an old building into new flats, maybe an office building conversion, and still attained help to buy approval on this. But development finance has actually gone up. The percentage has actually gone up as well. But a lot of specialist lenders are actually there to actually help first-time investors become regular buy-to-let landlords and HMO landlords. I don't know about any of yourself, but personally, I'm quite excited to see the return of all of these sort of deals that we did see back in the early 2010s around that sort of mark. But there's something unusual that's actually happened quite recently, is HMOs are actually being used in flats now as well, which I'm seeing. So we're talking of a 2-bedroom flat being rented to 3 different individuals, including the lounge. Councils are allowing this depending on the building involved, but it is becoming more and more of a norm. We've just completed one at the moment in Pontefract. Property is actually sold for 120,000, but the return is a staggering 1,887 per month in rental, which is a staggering return, and that's one of the best I've seen to date. We have another one in Leeds, which is going for 3750, which is a 250 purchase. But this comes to show how much HMOs come in for. A lot of my clients will sometimes say to me, there's a lot more hassle. It's a lot more headache. The simple question is, do you want 1,500 or do you want 2,500? If you want that extra £1,000, there is going to be a bit of work involved. How much physical work is involved? Maybe an extra 5-7% to the estate agent to manage this. Not a lot of money for that sort of return, in my opinion. But I think one of the most concerning things I've seen during the whole of lockdown, and I'm actually quite concerned about this, where I see a fifth of my clients refusing now to take out protection. I would say at least 20 to 22% of present homeowners or aspiring homeowners would not even think about taking out protection, no matter what the circumstance, whilst others revealed it'll be a big life change for them to consider it. A lot of people are concerned about spending 20 to 50 pounds a month on life insurance, but they would be happy to spend 100 pounds on a takeaway once a month. And to me, I just don't understand that. And maybe it's just my mindset from the field I come from, but it is, what are the reasons? I'm actually quite intrigued to know from our viewers, what are the reasons that would encourage you to consider insurance? Why would you actually not think critical illness insurance is important for yourself? Life cover is important for yourself. Family planning is important for yourself. So there are a number of things that I am quite concerned about. And over the next few weeks, I do want to actually do a few Q&As on life and protection, because I'd really like to know what people's views are, what people's concerns are, and maybe just do potentially if Surinder's able to slot me and I can do a presentation one day on life cover, on critical illness, and actually the benefits and the pros and cons of this and how important it can be. But at that point, back over to yourself, Dill stroke Simon. I'm not sure who's taking this on, but back over to you guys, and any questions you have, more than happy to stay over here for a Q&A afterwards. And very lastly, 85% lending has returned for buy-to-lets as well. So that's another very positive thing as well, which is not the norm, but it's there and it's here today.
Bobby, I can't wait for your presentation on family planning, mate.
Well, but I said family planning and I said that wrong. It's more the it's the family benefit. The family benefit is, unfortunately, should one partner pass away, children's fees would be covered up to the age of 18.
Bobby, I think everybody's looking forward to that one, mate. They've all got a smile on their faces.
There you go.
As a previous financial advisor, I've had that joke on me quite a few times as well. It does get boring, doesn't it, Bobby?
Well, no, it's all good. Dill's jokes are always funny.
Yeah, I'm not going to give up my day job. Sorry, just.
You mean Bobby Dill's always on the ball?
Well, there you go. Very, very right, Ranjit. Very right.
Yeah. Thank you, Ranjit. Just to finish off your comment on new developers coming in. So I know everybody. Well, if you don't realise, I'm a party wall surveyor. If you're new to development, make sure you do your party wall stuff. Please don't hold up your development needlessly until it reaches a point. And the reason I say that, there's a number of developments, 4 flats, 12 flats, so on, that literally come to a standstill for months on end. So that's my serious bit over. Simon, back to you for a moment.
Yeah, no, thanks, Bobby. That's it's good to refresh everyone's opinion. It became crazy when I was in the bank. I think it's worth talking about for just a second about the life side of it with buy-to-let mortgages, because people are saying, well, why do I want life cover for? It's an asset. If I die, the rent still comes in. And you just don't realise the devastation of death in a family causes.
It's
or,
awful. It's literally awful. Like
but the cost of a life insurance and bearing in mind that you and I are established professionals in this game, then we're not even doing it for the commission either, because it's they're very small premiums. They're actually, well, I don't know about you, but the takeaway business these days, when you get it from delivered, is 45-50 pounds for two people without even trying these days. So yeah, no, it's a really good point. So let's ask the boss to have a more of a detailed chat and put some numbers up. Anyway, we'll crack on with the show. Any questions, please fire them into Bobby. Let's go over to Ranjit and hear about property investor news. As you know, this is a magazine that we recommend all of our viewers should be subscribing to. This here from Ranjit, and Dill is still there, and you know what he's going to ask, don't you, Dill?
Good afternoon, everybody. How are you?
Very well, thank you, Ranjit. Good to see you today.
well, good to see you, Maharaja.
And you too, Bobby. It's nice to see that you recovered from your trip to Florida, is it, Dill?
Well, if that's what you want to call it, but yes.
Absolutely, and it looks like from his cough he's planning the next one as well, because he's
It's much better, much better. It's been a long 3 months.
I'm going to be missing next week, so it'll be me that's coughing next week.
I'd just like to touch on what Bobby talked about, the life insurances. I was on another a meeting, and the mortgage broker there did a mortgage for the client, and he also told them about the life insurance, and the client declined. And I think a month later, the husband passed away and left a hell of a lot of problems for the wife, because the bank wants to repossess, all because he saved on about 20-25 pounds.
It's unfortunately, we've all unfortunately had clients. I've had a client in the same position, and it's really sad. It really is sad. One of my clients is left by 3 children, unfortunately, and no life cover. It's not easy.
No, because the death is somewhere in the future and the life insurance is in the future. We don't think it could be now your future.
It's like, I think I had the same conversation with someone, and what they simply said was they were talking about how great it was going to the Terrace restaurant at the Dorchester, but they were prepared to spend £250 there, but £30 was too much for life cover, which would have given them potentially $500,000 of life only at their age. And I'm thinking, well, it makes me think, like, where are your priorities? Yes, you're young, but none of us are invincible. No. Look at in some countries in the world, people are going at every age. I know people in their 40s and 50s that have passed due to COVID with no underlying conditions. So it's concerning. I think but no, it's something that we all need to address and we need to take more seriously. I would actually be very eager to see reforms within regulation where, like the old days, you had to have life cover in place before you took out a mortgage. That used to happen in the older days. It wasn't anything regulatory as such, but lenders would have a commercial lending rule where they would say, Santander, for example, Abbey National, as they used to call it, for anyone that's not, that's not as young as me, but Abbey National, when we took out the first mortgage back in the 90s, they would simply say, without life cover, we won't give you a mortgage, which was great because they were being responsible lenders. But I think now it's simply tick a box, you don't have to have it. It's a shame. I'm sure Simon can agree. When he worked in the bank, it used to be more, it was a different thing then.
Yeah, it was, the problem was with it was it came on the religious grounds then, because some religions weren't allowed to take life insurance, and then if you were ill, you couldn't buy it either. And then there was all the mis-selling. I mean, banks are seriously guilty of mis-selling. And so they lost that battle, I believe, on mis-selling in the end, and just left it down to customer choice. And the trouble with choice is, as you said, people spend stupid money on going out for a meal and not £30 on a life policy because they don't think they're going to die. They just don't understand that bit. And when you tell them the stories, they think you're just trying to scare them into buying a policy. But if you position it correctly and you don't, it sells itself. That's how I used to find when I used to do it. And I never used to sell it because there's no point. You either position it and the client buys it, or they don't.
Just ignore it. Agreed.
I think if you haven't actually got it right in your presentation, then there's something wrong. So, but you really need that client to actually not be sold policy. They need to buy it.
They need to buy it. They need to understand it. Like, I'm not sure how it works with yourself. I'll be keen to know what your views are, Arif, as well, when you have a chat, like how you get involved with those sort of conversations.
You're jumping the gun. It's not Arif's turn. Come on.
Good point. Yeah, the show's getting way distracted.
It is.
Where is Ranjit? He's supposed to be doing a presentation.
There you go, Ranjit. I'm muting myself.
Allow him to share screen so we can speed the process up. Deal. Come on.
I think he can. He's just waiting for you guys to give him a chance.
Go on then. Let's go, Ranjit.
Can you all see the slide?
No.
Not yet.
I can see you.
No, Randy, you have to share the slides, I think.
Okay, can you see it now?
No.
No. You have to put 50p in the meter.
Who have you shared it with? Are you on multiple Zooms at the same time?
No, I don't know what Dill is doing on his side.
Oh man, this is not going.
If only we knew the answer to that question.
No comment, guys.
Is it all right now?
No, wait. Shit.
You still can't see me?
We can see you.
The slide?
No, not at all. We can just see you and Property Investor News.
Have another go, Ranjit. It says.
Okay, you tweaked something, yeah?
Yeah, I think so.
Tweak or tweet?
Tweaked.
Okay.
Not tweet.
I thought tweet. I thought, what are you tweeting about?
I don't know, it might be tweeting Dill.
Might be something else in a minute. Carry on. Right.
How's it now?
Now we've got what they call a technical hit, so you'll have to proceed without it, Ranjit. Sorry, without your slides, I think.
Okay.
The suspense.
I know. Gosh.
How are you doing, Arif? Keeping well?
He's waiting his turn so he can have a go. Come on.
Absolutely fine. Yes, guys. Yeah, but let Ranjit finish it then.
You want to swap it around the order?
Do you want to come on afterwards, Ranjit?
Yeah, I'll come on afterwards then.
Perfect.
Yeah.
Right.
We'll see what
We can sort it out then.
Okay, so
Just
breaking
swap.
news. We've got a small technical hitch, but hopefully that's the show must go on, as they say. So our next speaker, I'm going to do a really short, sharp introduction. Arif Punjani has more letters after his name than the Russian alphabet. Chartered accountant, knows his stuff about tax, and he's pretending to be embarrassed. But Arif, I'm not going to take up the audience time. You're eminently qualified to talk about everybody's favorite subject. We've talked about death before, and you're going to talk about taxes. So that's the running theme in this show. Over to you, Arif.
Absolutely. Well, good afternoon to all of you. I was pretty surprised with the findings of Bobby when he mentioned about the HMO into flats. But yeah, I'll discuss more later on. Myself, I'm Arif Punjani, one of the senior partner and founder at Matplus Chartered Accountants. We specialize into property clientele, particularly landlords, developers, and investors, arranging their tax plannings in order. Today's topic, I think you guys have kind of made up the environment before I could go for that, because you've been talking about the death and the life insurance policies. And the bulk of my today's topic would be around the inheritance tax, which is, I would say, the byproduct of the death. and as we all know, death and taxes are the only two certainties of life. So let's perhaps go on and uncover today's discussion. Let me try and share my screen first with you guys. Just confirm yes, if that's okay with you. Could you review my
Yeah, Arif, you're all good. SlideShare's working. It's just Ranjit's fault. It wasn't my fault before.
So yes, we made a topic as what does taxman doesn't want us to know. And before I could uncover and start my presentation, please take this particular advice as the fact that there is no specific advice in this particular presentation that I intend to make. So please do not do any DIY tax planning, and please do speak to professionals before taking any tax planning into your circumstances in order. So starting up with the what does taxman doesn't want us to know, I thought it's best to perhaps understand what taxman has done in the last 5 years, particularly around the property sector. So what changes have happened around the property sector, not looking at one particular aspect of income tax, but holistically looking at all the taxes that could potentially affect the property sector, i.e. whether stamp duty, land tax, even the value added tax, income tax, corporation tax, capital gains tax for that matter, and see how HMRC has kind of, I would say, attacked the property sector specifically in the last 5 years. And I would prove it by the legislation and the actual changes that has actually occurred in the last 5 years. So when we say, what does taxman doesn't want us to know, let us first understand what he has done in the past, and then what we can do to mitigate the tax planning, mitigate the taxes in the future through potentially the property incorporation tax planning, which is the most hyped and talked about. And lastly, we'll come to the property tax planning as well, the trust tax planning. And again, I'm happy to take any questions at the end, as mentioned. However, please avoid asking any specific tax planning questions. If it's generic in terms of creating awareness on the taxation side, if I do know the answer, I would be more than happy to answer. So let's start with what has happened around the property sector in the taxation for the last 5 years. Now, before we touch on the UK residents, let's go for the non-UK residents in terms of the non-resident landlords, or those who own the properties within the UK, but by virtue of being a residential status, they are not UK resident. In terms of the capital gains tax, and this was the most funnier, I would say, and perhaps most obvious one. So if I were to be an individual owning a property within the UK, and I'm not a UK resident, so I do not live in the UK, or perhaps live, in precise, simpler terms, live less than 183 days in the UK, I would not pay any capital gains tax liability on any residential property that I were to own up until 6th of April 2015. So simply, I could have had property in Chelsea back in 2000, sold property for 2014, made a massive capital gain, and have not paid any capital gains tax liability at all. I could have easily got away with it. HMRC realized it and thought, hey, what's going on? These guys are obviously making huge capital gains without paying any taxes whatsoever. So the legislation came into effect, particularly affecting non-UK residents owning residential UK properties, stating that any property that you would now own from 6th of April 2015 would be subject to capital gains tax. So to brief it in a way, say, for the argument's sake, the property was purchased for in year 2010. And the property was sold in the year 2018 by a non-UK resident. Only the gain eligible from 2015 to 18 would be subject to capital gains tax, not anything prior to that. So the first 5 years would not be subject to capital gains tax at all, because the legislation could have with effect from and could not go retrospective. So the benefits are still there for the non-UK residents who have been owning properties for many years in the past, or perhaps at least any time before 2015. That's around the residential side of it. Onto the individual. So then came the fact that yes, the legislation has now come for the individual and the residential. However, it doesn't say anything about the company. So the smarter guys, those non-UK residents, instead of owning the property individually, they started owning the property under the an umbrella of a company. So the same property I would buy, but under company name, not individually. And then it could be a UK-based company or offshore company, it doesn't matter. As long as it's a company, as long as it's not an individual, it's fine. And you would not be still triggered or captured by the capital gains tax legislation, which is 6th of April 2015 introduced into. And this went on as well. And not only from the company side of it, the specification says individual and the residential property. So the loophole could be, I could own the residential property under company name, or I could own the non-residential property even under individual name, and I would still not be subject to capital gains tax. HMRC only realized it 4 years later that this is what these guys are doing. And then the final legislation come, which states the fact that from 6th of April 2019, any direct or indirect disposal of any interest within the UK property would be subject to the capital gains tax. So whether you own the property directly as an individually or indirectly through a company or trust or partnership or any other structure for that matter, and whether it's any property within the UK, whether it's residential or commercial, would be subject to capital gains tax. But obviously it took them 4 years and the benefits was obtained in between those 4 years. But in a nutshell, even now, the non-UK resident landlords have been covered through the capital gains tax side as well. But that's on to the just touching base onto the non-UK residents, because they are most ignored in majority of the tax planning scenario. And they are the one, perhaps I would say, in terms of making investment within the UK, particularly around London area and the prime London area, you would see majority as non-UK residents, equally compared to the UK residents as well. So that's on to the offshore investors. Let's go to the situation as to what has affected us as a UK resident and what changes have come up in the property sector. I would start off with the capital gains tax, and back into 6th of April 2017, or before 6th of April 2017, there were no discrimination, I would say the word rather than the differentiation, between us selling a property which is a residential one or us selling an antique, which could be anything. So if you were to sell a property which has to be UK resident, UK residential property, then the tax rates would be different compared to any other asset that you would have sold otherwise. So if it happened to be commercial property or antique or any other asset you would have sold, the tax rates would be 10% or 20% depending on your taxpayer's position. However, if that were to be a residential property, then the tax rates are higher, 18 or 28% straight away. And this differentiation only came into effect in the last 3 years, purely because the fact that the residential property are bound to have more increment over the period of years as opposed to any other asset or perhaps even commercial property for that matter. And this was introduced just 3 years ago, or you could say 4 years precisely, more than that. So that's onto the capital gains tax, differentiating between the residential side of it. Then the stamp duty land tax, and we are all aware of it, the additional surcharge of 3% stamp duty onto any additional residential property, particularly bombarding the landlords, the buy-to-let landlords. So that came into effect from 1st of April 2016. So any tax rates that are there as opposed to what the first-time buyers would pay, standard tax rates of stamp duty land tax, the buy-to-let landlord would pay that plus 3% in addition to, and this was introduced only on 1st of April 2016. And thereafter, this was a silly one, but there you go. The stamp duty land tax was supposed to be paid within 30 days. From 1st of March 2019, it's supposed to be paid within 14 days. HMRC says, why should we wait for even 2 more weeks more? Let's let them get paid within 2 weeks. But anyways, majority of the time when you do the conveyancing, the legal professionals deals with it. So that's 14 days as opposed to 30 days for the stamp duty land tax. Coming to now income tax, the finance cost restriction, the most talked about and the most hyped around the property sector, particularly onto the buy-to-let landlords for the residential or commercial for that matter, is the finance cost restriction. I will explore further into the next presentation slides, but it came into effect on 6th of April 2017, which in a nutshell meaning that the mortgage cost that you would be paying towards the property could no longer be deducted to arrive at your net rental profit calculations. So that's in a brief for it. And as With it, it also came the legislation of abolition of dividend tax credits. Many of us who are owner-managed businesses would know that prior to 6th of April 2016, there was nothing called a separate dividend tax. There used to be a dividend tax if you could pay, but that has to be more than the basic rate allowance. So up until the fact that basic rate allowance as of now, if this were to be say up to 50K, you would not have paid any dividend tax. You would have paid dividend tax if your dividend were to be more than the basic rate allowance of that particular fiscal year. That changed, and that changed to the fact that initially it was introduced to £5,000, and then further it got reduced to a ridiculous amount of per person £2,000 dividend tax threshold. So any dividend that you were to withdraw and more than £2,000 would be subject to immediately at the rate of either 7.5% if you're basic rate taxpayer, or even 32.5% if you're higher rate taxpayer, depending on your taxpayer's position. And this came into effect from 6th of April 2018. If you can look at the years 17, 16, 19, 18, 16, 17, all within the 5 years. All this is happening around the property sector in the 5 years only, not more than that. Touching on to the, again, income tax side, in terms of arriving at your net profit calculations for the property, you could be given a 10% wear and tear allowance. So say, for example, your rental income is £10,000 per annum. You could just be given £1,000 as a deduction. Yes, you can deduct it off for your repairs and maintenance and general wear and tear allowance as a 10%, which is £1,000. It's been abolished. It's no longer there. It has to be the actual cost as opposed to the an artificial 10% allowance part of it. And lastly, and the most importantly, which is the inheritance tax, like I said, the atmosphere was developed around the life insurance policy and the deaths and the fact that people don't think they would be dying one day. And HMRC knows very well the weakness of the taxpayers. And this is the reason why the nil rate band, which is the threshold up to which the inheritance tax would not be payable and then thereafter it will be payable, has been frozen since 2009. So as you can see, the nil rate band were being increased from 2002 to 2003 to 2004 every year, just like is a retail price index increment. But then all of a sudden from 2009 till now, and not only up until now, it would be frozen till 2025. And the rate would be £325,000 only. They have introduced, HMRC has introduced an additional nil rate band, which is called residence nil rate band, with its complication as usual, and the devil is always there in the detail. But having said that, yes, you could get up to $500,000 of residential nil rate band combined with a nil rate band, provided you live in a property in your, which is your principal private residence where you're living it, and you're giving it to your descendants, your direct descendants. So unfortunately, if you don't have descendants, that's a problem. You can't have the residence in that band. Nor does the fact that if you do not live in a property which is worth equivalent to that value. But again, that is a discussion for some other time. So that's onto the inheritance tax and residence in ban. All of it around in and around in the last 4 to 5 years. And the changes which results into obviously more revenue to the HMRC. And just touching base more onto the inheritance tax side. So comparing it with the what has been frozen for the nil rate band for inheritance tax back in 2009 till now, the income tax threshold in 2009 was 6,475. Currently is 12,570. So up until that much amount of up until that much level of amount of the income, you would not pay any tax, which is income tax. Thereafter, you start paying it. So as you can see, there's a 94% increment onto the allowance threshold for the income tax. If you look at the NIC primary threshold, there's 64% increment. It was 5,720 before, it's 9,500 now. And if you look at the other NIC, so on and so forth, there has been some increment in line with the retail price index. But you look at the inheritance tax, £325,000 before, £325,000 now, and no one's talking about it. And the reason why no one's talking about it is the fact that the inheritance tax would be payable by the beneficiaries of the estate. And the beneficiaries of the estate are normally not the people who have actually accumulated the estate. And they do not have a say. Had it been the fact that the dad could have been reborn and could say the fact about, could mention about the inheritance tax, then he would know how much pinching it would be. But as of now, in this particular instance, since the person whose estate were being subject to inheritance tax now is no longer there, there's no shout around it. And HMRC knows that very sweetly. And the fact that it's been told, not only the fact that inheritance tax has been mentioned as a death tax and a double taxation, because it's a taxation on to your already earned and paid tax income or capital gain or corporation tax, whichever they paid on. But at the same time, it's a tax which hasn't been pinched at all to even the beneficiary, because it's not their hard-earned money. It's their father's or somebody else's funds, which they're getting it anyway. And the worst side of not doing the inheritance tax planning by giving you a live scenario example is here. So you've picked up few properties as an example. One is in zone 1 and the other one is zone 4. These are the actual property valuations that we've obtained in terms of the sale proceeds. So zone 1, this property back in 2009 was worth 730K, and this one was 380K. Currently the valuation of these properties is about 1.4 approximately, in 680 here. So almost they've doubled in value over the period of these years. So when we look at the increment in value, these are actual figures. The increment in value on this particular property is 634,000 pound, 500, and here is 300,000 pound increment. If no tax planning is done, particularly for the inheritance tax, the additional inheritance tax liability will be payable. I'm talking about the additional, not the actual. The additional inheritance tax liability will be payable as a result of this increment in value, because the nil band hasn't increased, is £250,000 here for the zone 1 property and 120,000 pound on the zone 4 property. All in all, assuming that their nil band were utilized and these were their buy-to-let investments, there is a £500,000 total inheritance tax liability to be paid, over £500,000 here, and over £250,000 here, 272,000 pounds. These are huge figures when it comes to inheritance tax. No wonder, because it's 40%. They have to be huge anyway. But having said that, if no tax planning is done, then this is what we end up paying. And these are the actual figures which would actually go out to the HMRC eventually when the person were to die. And hence the reason it's very vital to understand one's estate and plan accordingly, particularly on the inheritance tax side of it. So that's on to the inheritance tax. Coming to the income tax, which is section 24, and it's been talked about for the last 4 years or more. In a nutshell, that's what it looks like. So from 2017-18 till now, till the last year, I would say the last fiscal year was the last year it got completely implemented. So from the first year onwards till the last year, this is how it allows in terms of the mortgage interest cost that you could deduct. So from 17-18, you could deduct only up to 75% of it, then gradually reduce to 50, then 25, and then last year you could not deduct any. So in a nutshell, yes, mortgage interest cost can no longer be deducted from the property net profit calculations. So if I have made a £10,000 worth of gross rental income and my mortgage interest cost were to be £4,000, ideally common sense, my profit would be £6,000. However, HMRC would say no, your profit would still be £10,000. This created panic around the buy-to-let investors and the landlords, which unfortunately many tax advisors took very unfair advantage of it because of the fact that the people were not so aware or perhaps tax savvy around this particular topic. And it obviously means increase in profit. You would have increased rental profit. That means you would pay more tax. So do something about it. Yes, you need to do something about it. However, you also need to look at your personal circumstances scenario. And I would tell you why to a certain group of people, this particular legislation would not affect. It would only affect to the others whose income are above a particular threshold. And I will prove it with the evidence as to how it would work out to be. So the calculation suggests that section 24 would not affect to anybody whose total income, even up until, if you consider the last fiscal year as a benchmark, whose income would be up to 50K. If my total gross income is up to 50K, including all sources, which is whether it's employment income, my rental property income, dividend income, so on and so forth. If it happened to be up to 50K, I should not be worried. This section 24 would not affect me. How? Let's look at the live illustration to understand further. So let's say, for an example, of a person whose income is below 50K. So we are taking for the argument here, the rental income earned is £40,000. The mortgage interest is £10,000. So obviously net profit will be £30,000. This is prior to the section 24 legislation. That's the reason we say it's before. And see what the income impact it would have onto the income tax side. Then you would deduct the personal allowance, which is 12,570. the net taxable income is net profit minus your personal allowance, which is 17,430, and income tax that you would pay is 3,486, which is precisely just 20% of the net taxable income. Now, look at what has happened afterwards. So thereafter, you would have mortgage interest cost. Yes, same income, same mortgage interest cost. However, you would no longer be able to deduct the mortgage interest cost from your gross rental income. And hence the reason your net profit would now turn out to be 40 and not 30. Now, the personal allowance would remain the same. That means your net taxable income has increased dramatically overnight to 27,430 as opposed to 17,430. And this is where the panic comes. Oh, my tax liability has now gone up. Instead of 3,486, is 5,486, purely because 10,000 times 20%, £2,000 is now subject to more income tax. However, what is not being considered is HMRC would still give a relief at the basic rate of 20% of what has not been allowed to deduct. So £10,000 was not allowed to deduct. HMRC would give you relief at 20%, which is £2,000. And your tax liability, net tax liability would still be 5,486 minus 2, which is a magical figure of 3,486. So whether it's before or after, as long as your total income remains up to 50K, the gross rental income, it would not affect you. It would only affect if your income goes more than £50,000. And let's look at that, for example. So here we're going for 80K as opposed to 40 for the gross rental income, and doubling the mortgage interest as well, giving us the profit of 60K, the same personal allowance, which will give us the income tax liability of 11,472. And here the income tax rate would be 40% because the income is more than £50,000. Let's look at the after example. So £80,000, yes, everything would remain the same. However, same as the after situation for less than 50K income, the mortgage interest cost could no longer be deducted. So you would have your net profit as about 80 as it is, what it was before. So it's not going to be 60, it's going to be 80. You can't deduct your mortgage interest cost. Same personal allowance, giving your net taxable income higher, and your income tax liability would go up. Now the trick comes, you would still be given the relief at basic rate, but at only 20% of £20,000. You're paying tax at 40%. So £4,000 would still be deducted, but that will make your income tax liability at £15,000 as opposed to what it used to be, £11,000. Now this is where the differences are, and this is where you would start paying more income tax. Obviously, depending on your total income, you would start paying more income tax as opposed to your mortgage interest costs. So instead of £11,000, you're paying for £15,000. So like I said, section 24, yes, it is lethal, but it's only for those buy-to-let landlords who, I would say, about 3 or 4 or more with your gross rental income more than 50K. Otherwise, it would not be. Or even for that matter, if you do not have, if your properties are not having any mortgages on it, then it simply doesn't affect. It only affects to those residential properties, UK residential properties, which has got the mortgage cost on it, which has got the regular outgoing mortgage interest cost on it. So that's on section 24. And now, before we go for and evaluate as to what now can be done, we know what has happened and what has done by HMRC to get more revenue from property sector onto the taxation side. What can we do now? And rather than joining the herd and just doing what others are doing, tax is something that cannot be copied and pasted. And I truly believe there has to be tailor-made solutions for each, because each and every individual is different and the circumstances around taxation will be different. Every couple is different for that matter as well. So, I mean, I do not believe in any off-the-shelf, one size fits all does not work in the property, in any tax planning, let alone the property side of it. And factors that I particularly consider, and all taxpayers should perhaps pay attention to these factors when it comes to tax planning, are the fact that the property ownership, if you own properties as of now and you're concerned about the taxes for that particular property or properties for that in future, how are you owning those properties? Are you owning them individually or in partnership with your spouse or some other business partner? Are you owning them under company, trust? How are you owning them? How many number of properties you have? Is it just 1 or 2, or are we talking numbers in terms of 30, 40 or more? How many number of hours do you put in to do the property businesses? So is it buy-to-let business of renting out properties, are you putting more than 20 hours or less than 20 hours? Because it matters the most when it comes to property incorporation side of it. Further, your gross property income, like I've mentioned before, is just one of the aspects that to consider. Is your gross property income will be more than 50K or less than 50K? And net estate value. How much would be your total estate value that you think would be subject to inheritance tax? Would it be less than £325,000? And I say net, not the gross. So if you own the property which is worth market value as of now 100K and the mortgage on it is only £25,000, then your net estate is obviously £75,000. So that's the value we are talking about. How much is your net estate value? Whether it's less than 100 grand, more than 1 million, or more than 10 million. Depending on these values and depending on what the answers to these questions would be, the tax planning would be tailor-made accordingly. And again, depending on the property income as well, whether you rely on that particular property income or you're okay for the property income to get more retained within the entity of company or trust, you could go for the company or trust tax planning as well. Now, let's perhaps touch on the incorporation of property portfolio, which has been discussed hundreds of times by many tax advisors. But here, I'm just going through some of the pitfalls and some of the areas that should be considered before going for the property incorporation planning side of it. I'm not saying it's not good. It's definitely a very good tool. However, it's not one fit for all. And depending on the circumstances of a particular taxpayer, it may not be suitable. And why I would say so is with the illustration here. So when you incorporate your property portfolio, whether it's 5, 10 or 50 properties that you have, and you want, previously you were owning under individual name, and now you're forming a company and you're putting them under company name through the partnership deed, purely because you want to avoid section 24, and also it will have the advantages of the capital gains tax upliftment as well. But remember, it's the exercise of putting all your eggs into one basket. So previously, a taxpayer who perhaps had owned 14 properties privately with his or her spouse, now all of a sudden a limited company has been formed and the information is available online on the public record. So something which was secretive and private and confidential is now available for anyone to inspect on. So factors to consider when you do the property incorporation portfolio is the capital gains tax relief, and this is the most crucial side of it. Unless the incorporation relief is formed, you would trigger the capital gains tax liability, which for me doesn't make any sense. So please refer to the Ramsey case and make sure that it falls, your circumstances fall within that particular criteria. For me particularly and personally, portfolio of less than 5 properties doesn't seem to go and fit into the capital gains tax relief side of it. And the reason why, because it will be very difficult to prove that you're putting 20 hours or more to recover 20 hours or more to do your property business. And if it's not more than 20 hours, then it would not be treated as a business. And if it's no business, then there is no incorporation relief. And if there is no incorporation relief, then you would pay capital gains tax liability. The worst part here is the fact that HMRC would not give you any non-statutory clearance here. So you should know what you're doing and how you're doing it, because HMRC could come back to you 4 or 5 years down the line in stating the fact that you have done the incorporation, congratulations. However, we do not believe it to be a business and hence pay the huge capital gains tax liability. So this is something you need to be very, very confident about, the fact that it would not result into further CGT for you. Secondly, the incorporation would also trigger the stamp duty land tax on the market value unless you prove it's a partnership. And it's a straightforward case for the properties owned between the husband and wife or partnership for that matter. However, where the property will be owned individually and perhaps a family member is proposed to add within the partnership to make it as a partnership and then to perhaps convert into an LLP or limited company, the care needs to be taken. But without doubt, one person could not form obviously a partnership, and without partnership you would not have SDLT relief. And if there is no SDLT relief, then you pay unnecessary stamp duty land tax just on the advantage of forming a company, which again should be evaluated in terms of the cost that you would result into paying, particularly in the current circumstances, as opposed to the benefits that you would receive from forming the company over the period of years. When you form the company, yes, there will be professional fees, such as myself. You will have the lawyers to change the title deed. You would need to pay for the valuers, and so on and so forth. So there'll be some significant fees around, which should go part of your costing to do the property incorporation, and that should be evaluated against what benefit again you would receive in future by incorporation. You would have to refinance the entire property portfolio, which eventually would happen, and the rates are particularly higher for the limited company, which Bobby would mention, as opposed to individual. So they especially, I mean, they would not be similar. They would be slightly higher. How much higher, we don't know, but it will be higher. And then there would be over dependency on a particular lender, one particular lender, as opposed to you would have the variety of lenders if you were to have 14 properties. It could be good, it may not be good, depending on suiting individual circumstances, choices. That's that. And lastly, like I've mentioned earlier, your private information about the properties that you own, your estate, is now all of a sudden a public domain case. Anybody can log in and find out how many properties you own and what are the values of that particular property at the end of a particular accounting year end. So yes, it comes with the advantages, but some disadvantages as well, nonetheless. That's onto the property incorporation. And now let's look at the fact that if you were to incorporate the property, what impact it would have if you do not do a careful tax planning and difference between the individual and the company side of it. So say, for example, we haven't done the property incorporation, and my properties that I have owned previously, I have continued to own as individually as it is. If I were to have if my income were to be below 50K, which is below the basic rate band, I would just pay 20%. If my income were to be more than 50K, I would, yes, of course, I would pay 40%, and then so on with 45%. What it would happen if I were to be a corporate? So if I have incorporated my property portfolio, what the result would be? I would pay the corporation tax instead of the income tax, which is 19%. But at the same time, I would also pay the dividend tax of 7.5%. That combines makes it 26.5% as opposed to 20%. And hence the reason, as much as I've always mentioned, property incorporation is good, but planning needs to be done around the dividend withdrawal, because there is no point doing the property incorporation. Yes, you can deduct the mortgage cost, but if you're hired a taxpayer, the scenario here is you're just paying 40% as an individual. The scenario as a company is 19 plus 32.5, giving you a 51.5% tax, as opposed to 40% tax. So yes, it's a tricky one, and it's very, very vital that you withdraw. I mean, in essence, what HMRC is trying to do is the fact that limit the amount of withdrawals a person can do from the company. You could do investment, you could do reinvestment, that's fine. But if you were to withdraw funds from the company for your own, for the directors or shareholders' personal use, that's the time you would pay dividend tax on. And that is something to be thoughtfully and carefully planned about. Then goes for the capital extension as opposed to rental income. So if considered how much income tax or corporation tax we would pay if it were to be a rental income. Let's talk about the capital extraction on the sale of the property. So while the property is earning income, yes, that's good. But what if you sell the property? Well, if I'm an individual, if I were to sell the property, like I said earlier, 18% is the capital gains tax if my income were to be below 50, and 28% if my income were to be more than 50. Now let's look at the corporation tax. The corporation tax would remain the same. The corporation share, which is 19%, and again I would pay dividend tax of 7.5%, because if I were to withdraw funds, if I don't withdraw, the tax stops at 19%, and that is it, which is 26.5. And if I do withdraw, then it comes to 51.5. So hence the reason I said it's beneficial for those whose income is up to 50K to have properties under individual name rather than the company name. Because under company name, even if my income were to be below 50, but if I need those funds, and that is the reason why I've sold the property, I would eventually end up paying 26.5% as opposed to paying just 18%. Not only that, under individually, I would have the annual exemption of up to 12,500, which is a threshold up to which point I would not be paying any capital gains tax on. I do not get that under company. Under company, even a pound gets subject to 19% corporation tax, giving you 0.19 pence corporation tax to pay. So advantages and disadvantages onto the company side is beneficial definitely for those with 10 or more properties, no two ways about it, but not for the lesser ones. But again, individual circumstances has to decide which way you want to go for. And let's look at the examples of how the incorporation of the property portfolio would have an impact as an individual and as a company. So this is the example that we have taken in terms of the years as an individual. You had the rental income, you had the interest cost, and this is what the net profit would keep on going up for. And the basic rate band, that basic rate relief that you will be given, and the amount of increment in the income tax that you would pay for the same amount of the rental income that you would earn. So the same rental income, but then yes, the idea is that you would eventually end up paying more if you don't do the tax planning. So this is what you would pay more, 1,800 here, as opposed to under company. This is what the scenario would look like. Analyzing that, yes, throughout the years and ongoing as well. I mean, as of now, there is no legislation which says that you can no longer deduct the interest cost from the company for rental income. But God forbid, if the legislation were to come for the rental property investment business, then that would be the end of majority of the property investment companies. But these are the examples. You would have the profit standard as it is. Your corporation tax would be standard, and the profit after tax would remain as it is as well. It all boils down to your dividend tax. If you could stop, if you could limit this dividend tax, then you would have significant amount of tax savings. But even if you do not have, even if you cannot withdraw limited dividend tax, and even if you end up withdrawing the full funds, you would still have some savings compared to what you would have under individual under company name. The savings would be there, but is it significant enough to incur the amount of cost for the incorporation side of it? That is something you need to evaluate. So I mean, here in this particular instance, even for the year 2021, is £1,400 worth of the savings that we have. And typically the property portfolio converting into limited company would cost you a lot more than 1,400. So it would be perhaps a case of break even, say 6 or 7 years, and then thereafter you start making profits, but it needs to be carefully thought for. The other planning that I typically advise on, which is apart from the incorporation, is the trust tax planning, which is more of, I would say, healthier way rather than going for the property incorporation, because there is no change in the title deed as with the trust. You could save not only the income tax and capital gains tax, but more importantly the inheritance tax as well. Income tax, how I will show you later on. The capital gains tax, because any transfer of property within the trust would be subject to capital gains tax section 20 relief, which means you can claim the holdover relief and capital gains tax liability would not trigger. And obviously the inheritance tax, any property that you would transfer within the trust, the 7-year clock would start from there on, and subject to you living 7 years, that particular property would no longer be forming part of your estate. That means you have saved the entire 40% of the property value that you have settled into trust for. Let's look at what trust income tax would be and how we could potentially save on. So say depending on the type of trust you create, which could be typically either interest in possession trust or discretionary trust, we typically advise for the discretionary trust, which is 45%, because it has got the power, it is the most powerful trust as opposed to the interest in possession trust. This is typically used between the husband and wife, as opposed to discretionary trust, which is more widely used, not in a particular family structure, but can be used by majority of any circumstances that could be fit for. And the example that we intend to give you here is how the dividend distributed from the trust can be used as a tax claim by the trust, by the beneficiaries. So net dividend 5,500, re-tax CPM in 4,500, and total property income 10,000 pounds. Let's look at this one more in this scenario now. So in the example one, this is the trust. Trust has made an income, a net profit of £1,000. Depending on the type of trust you create, you pay tax. Whether it's discretionary trust, then it's 45%. If it's interest in possession trust, then you pay 20%. So say, for example, if it's discretionary trust and it's most powerful fund, which you've paid 45% tax on, but don't take a heart attack for now. You've paid £450 tax. What is now left over is 550. If this 550 is given to a beneficiary who's got no other income but just the dividend from the trust, when this particular beneficiary would file its tax return, HMRC would pay the tax suffered by the trust to this particular beneficiary, purely because it's a dividend from the trust. This rule does not apply to dividend from the company. If you were to receive a dividend from the company, you would just simply pay that particular dividend tax and that's it. The beneficiary of the dividend, whether it's director or shareholder, is not bound to claim any tax back from the HMRC because it's a dividend from the company. The legislation are different completely altogether when it comes to trust. HMRC are more lenient and I would say perhaps more sympathetic towards the beneficiaries of the trust. And depending on the beneficiary's position, you could claim the entire tax back. Here, the beneficiary was zero net taxpayer, so the beneficiary did not have any income. HMRC paid the entire £450 tax back. So in a nutshell, you have not paid any income tax with smart tax planning. Or even for that matter, the beneficiary had some income and the beneficiary was a basic taxpayer, you could still claim a proportionate amount of tax, which in this instance, 250. So even with this example, you have just paid 20% income tax with the added advantage of saving the inheritance tax as well. So it's very beneficial to have the trust in place. And it doesn't force you to change your title deed for that matter, because the owner would also be the trustee of the property and that would remain in line with it. So before I conclude, I would like to just give you tax tips as to what we have discussed. So we discussed about the property incorporation, we discussed about the property trust tax planning and what taxes has been bombarded by HMRC over the last 5 years. Let's look at a standard one, which is a spousal tax planning. Husband is a higher taxpayer, income is more than 50K, and plus he owns few properties which are buy to let. And say property income is about 40K and spouse has got no other income. What you could just simply do is outright transfer, but that would result into the conveyancing legal fee, or you can just simply do a declaration of trust. That doesn't cost that much. And to allocate the beneficiary in the beneficial interest through the trust to your spouse who's not earning any income. That would result into straight away utilizing your non-working spouse's unused personal allowance. So that's straight away 12,500 or currently 12,570. On that you would not pay tax on. And the remaining you would pay tax only at 20%. The spouse would pay 20% as opposed to the main husband who were paying 40%. So the overall tax savings would be about 10,500. This is just a simple one. A very basic, simple tax planning, just evaluating what your spouse is doing and whether you could utilize your spouse's tax unused personal allowance. Also, the same would apply to using spouse's unused dividend allowance as well. And of course, more the income of the husband, more the savings can be made. Now, if in the previous example of the property incorporation planning, say you could not do the property incorporation because you had only 3 or 2 properties and you could not justify that you are putting 20 hours or more as a business, or perhaps you're owning the property only individually and not with any family members, and you do not want to go for the property incorporation planning, what the least you can do is you can form a property management company and transfer up to 15% of gross property income into a limited company. Up to 15% HMRC is permitted to say that you can transfer it as a development, as a management company to manage a property portfolio business. So up to 15% of your property rental income would be subject to lower rate of 19% particularly if you're higher rate or additional rate taxpayer. And that would save you straight away 21% or even 26% depending on tax specification. I hope it has been fruitful and I went a little faster as opposed to what I was supposed to be given the time constraint. But I hope you would have enjoyed it, and feel free to ask any questions. But please, no tax planning questions. Awareness, knowledge, I'm more than happy to. And again, the health advice one more time. Do not take this presentation and implement straight away. Please seek professional advice before doing so. Over to the most funny guy, Dilguja.
Thank you, Arif. Don't worry, I'm not going to give up my day job. No plans for comedy club. Thank you very much, Arif. I said this in the last few weeks, and I think it applies to more this week than any other week. I should have given a heads up warning, put your coloring pencils down and get your writing pens out, but you very kindly provided the slides. If anybody wants slides, get in touch with the group, they'll pass them on to you. I've got a number of questions, and if I can go through a few.
Please, yeah, go on.
Yeah, so I know you're qualified to answer this question, actually.
I hope so.
There's a belief that if there's no will, that one partner's assets automatically go to the other one, i.e. husband's go to the wife or the wife's automatically go to the husband on death. Can you tell us what the answer on that one?
Yes and no is the answer. So if there is no will, the person has died intestate, i.e. the intestacy rules apply of the UK government. If the person were to be domiciled within the UK and died within the UK. So say husband has died, and I don't know why I keep on choosing husband as opposed to wife, but one of the partner has died with no will in place, died intestate. Now, depending on how the property, say one property was been owned by both husband and wife jointly, depending on how the property was owned, the property could potentially have it has the potential to get automatically transferred to the surviving spouse. So if the property were owned as a joint tenants, and there's a significant difference between joint tenants and tenancy in common. So property could be owned between both the partners, 50-50 again. But if it's owned as joint tenants, then by virtue of, there's something called clause of survivorship. By virtue of the clause of survivorship, the surviving spouse automatically get the 50% of the deceased spouse. In which case, yes, the property would get transferred to the surviving spouse automatically. However, if the same 50% were owned not as joint tenants, but as tenancy in common, then the person who died has died with his own share of his own estate. That means that share would now be subject to intestacy rules. It would not go automatically to your spouse. Majority of the time, the solicitors would go for the joint tenancy, particularly if it's married or same-sex or opposite-sex partners, but not for the business partners. So if it's Mr. A and Mr. B are completely different and they own the properties as tenancy in common, and Mr. B were to die, then Mr. B's share of the property would get subject to his own estate inheritance tax calculation, and it would not get automatically passed over to Mr. A unless it's owned as joint tenants. And I hope I've answered that question.
Yeah, no, that's a super one. What I was thinking of where they have a portfolio of, I think they call it an estate. The estate is £1 million, and not all of it's automatically going to go to the husband.
So nothing would go to automatic. There's nothing automatic in this world apart from the joint tenancy that I've particularly mentioned. So if all the properties were been owned by husband under his own name only, then it would be subject to intestacy rules. It would not go to spouse. The first 250 with the properties share, there's a big rule of the intestacy side of it, would go to spouse, but not all of it, of course not.
So it's quite important for husbands and wives to have wills.
Absolutely, no two ways about it. I mean, not only just husband and wife, but anybody for that matter. I mean, you guys have mentioned the importance of the life insurance policy and the fact that people would like to think no one's going to die one day, but we all are going to be. So wills and power of attorneys are the most important piece of document. It doesn't cost us, to be honest. I mean, average will charge cost about 200, 250. I mean, we charge 250. I don't think it would. I don't think I'm yet to meet a guy who has paid 4,000 or 3,000 pounds to draft the will. So yeah.
Yeah,
it's a no-brainer.
Thank you very much for that, because that's a misunderstanding. Section 24, you talked about the 50k cutoff line. Does that, well, I assume though, and thank you for those illustrations, really well done. So thank you very much. It really comes through really well. You talked about rental income. Does that change if the income partner has a wage and a rental income?
So that when I mentioned your 50K, the 50K is all inclusive. So it has to include your employment income. It has to include your gross rental income as well. And I say gross, not net, gross rental income. So any of the non-savings income, but rather than using this accounting and taxation jargon, in a simplified manner, employment income, your gross rental income, dividend income would not matter because that will go part at the end. So any non-savings income, your partnership income, any other business self-employed profit you would have, all of it combined should be up to 50K.
Right, and there's a viewer's question here. I think you did actually answer it, but just to reconfirm, the $500,000 limit that's not only in London; it's anywhere in.
No, of course, yes, it's throughout the UK. However, there are, as I've mentioned, the devil is always there in the detail. The legislation states one of the requirements is that you have to have descendants, direct descendants. So you have to have children or grandchildren, and that particular property is going to children or grandchildren. So even if you have children and you're giving the property to your uncle and aunt, then you would not get the residence nil red band. And secondly, you have to live in a property which is worth that particular value, at least $500,000. So if you are living in a property worth say 600K market value, but there's a mortgage outstanding of worth £300,000. So actually the net value is only 300, and you're not going to get $500,000 because $500,000 is max out amount. So it is the higher of the actual net value of the property, or $500,000. So the lower of it, and the lower here in this instance is £300,000 only. So you would not get it.
Okay, yeah. Well, you wouldn't need it. I assume that's. You mentioned the 20-hour rule. Does that apply to one of the partners or both the partners in a partnership?
20-hour rule applies to the property incorporation portfolio particularly, as this is kind of a benchmark to state the fact that it's a business that requires 20 hours a week to run. And it was fought and won for the Ramsey case. And this is where it all started, because earlier it wasn't considered to be letting out and renting and doing buy-to-let business as a business. It was just buy-to-let business, as if not considered by HMRC as a business, because when you file HMRC self-assessment tax returns, it goes under the UK property section, not under the self-employment section. And hence the reason the 20 hours rule is 20 hours per week. So you could have just 2 properties, and that 2 properties could have 19 block of flats, but it obviously takes you a lot of time to manage them. And as long as you prove that you're managing it with 20 hours is fine. But if you have estate agents, if you have any managing agent to do so, that will be difficult for you to justify it. And if you can't prove it as a business, then you cannot claim as the capital gains tax relief.
Great. You then talked about incorporation, and so it's really great that you made the point that incorporation doesn't work for everyone. It's sort of like
but not only just incorporation, any tax planning for that matter is not one fit for all. And unfortunately, the market is full of advisors who would just sell you whether it fits you or not. It's very, very important that you ascertain the fact that whether that particular tax planning would lead you where would you stand 3 or 4 years down the line, and the calculation has to be backed up with it, and whether it suits you, whether it fits you with your requirements or not. I'm glad you're asking so many questions. I thought you were not, that you had gone to sleep. But yeah, I mean, you're clearly awake and listening. But there you go, Dale.
On this one, right? I've got to come to Bobby's list here in a minute. So just a few more, if you don't mind. LLP. Can you tell the viewers what LLP stands for, and is it tantamount to a limited company?
So LLP is a limited liability partnership, similar to the limited company structure, as available. The records are available onto the company's house on the public domain, and it's typically formed when you do the property incorporation, because the premise is the fact that the tax advisors prove it's a partnership business. It's a business and it's a partnership business. It's a business to claim the capital gains tax relief, and it's a partnership business to claim the stamp duty land tax relief. And once it's done, it's converted, and the normal partnership gets converted into LLP, which can then later be converted into a limited liability company or be left as it is. So as it is a limited liability, whether it's company or partnership, doesn't matter. So each partner's liabilities are different. It's mostly used in the professional services such as accountants, solicitors, doctors, and so on, because one partner doesn't want to be held liable for the other partner's negligence or fraud for that matter. So this was the concept initially introduced as LLP among the professionals, but then again, it got more I would say sought after within the property incorporation portfolio side of it as well. But yeah, LLP is in essence becomes a limited liability company from the property incorporation portfolio point of view.
Right. No, that's a really good explanation, really concise. Bobby, I'm going to let you have a chance because I've got a few more questions to go. But
before Bobby could fire me with the questions, I would want to ask him as well. And I was really surprised to know the fact that HMO flats converted into HMOs. And I'm shocked with the fact that it's even permitted. Is it permitted development?
Arif, as you've done such a great presentation, you can ask Bobby as many questions as you like. Bobby, you're in the hot chair, mate.
I would say in answer to that question, it really comes down to what the local authority allow. The local authority would most likely want a HMO license for a 2-bed flat because it is more than one family living there. But yeah, we've done them in Harrow where 2-bedroom flats have actually been rented to 3 individuals. You'll be surprised, even if you actually rent something to an estate agent. I'm not saying it's right or wrong, but on many occasions they'll rent it to 2 professionals, one tenancy. So in my view, that is also an equivalent of a HMO. They may be receiving, we have a client in Northampton that's doing this. They've rented a 2-bed flat to the estate agent. They're receiving 700 rent, but now that it's actually come for renewal, they're actually going to receive 950 if they get 2 individuals in. So automatically you can actually see the estate agent's probably making the money. And yes, for a bit more hassle from your end, why not earn the money?
Yeah, of course. I mean, more income. You would not generate more income without the same amount of hassle. Of course not.
Exactly.
And you also mentioned about 85% loan to value on the buy-to-let properties. Yes. Is it for individually owned or is it limited company owned as well?
Both. 80% never really went away from the market, even during lockdowns in personal name. Limited company did vanish for a short while, for a majority of the year. 85% personal and limited. Rates are not great, but everything depends on how green your apartment or house is. So the stronger the EPC rating, like we have a case going through today, and it's a 5-year fixed, 80%, but the mortgage offer restrictions are the EPC needs to be an A, B, or a C. So there'll be various restrictions in place.
I guess that's because of the EPC legislation crawling in slowly over 2025 and 2030.
Exactly, but the EPC, it's valid, we've just got one done. It's a grade C, valid till 2031, came through last night. Good thing is this can all be very easily checked, but I'm seeing more and more lenders asking about EPC, where before it was left to the applicant, it was left to the solicitor, but now it is becoming quite the norm as conditions of the offer.
Okay.
Arif,
right. Yeah.
We're going to try and get our money's worth out of you today. LLPs and partnerships, can you vary the profit year to year, or is it got to be done on a bigger time period than every year?
The answer is yes and no. It depends on how the partnership deed has been structured and devised by the solicitors. And again, we instruct them as to how we would want it. We would want it in a most flexible manner. So where we do it, yes, we say we want it in a most flexible manner as to how much we can divide and how much we can give the partnership profit to each and every partners within the firm. But you have to be reasonable there. You can't take things for granted because unnecessarily it triggers HMRC investigation, not necessarily meaning you have done something wrong. But if imagine you're filing 2 persons tax return, 1 year you have given one person 90%, the other one 10%, and the other year you have given 90% share, 20%, and the other one 80%, and you keep on fluctuating every year. It seems HMRC would also have something called automatic highlighter as well, that it highlights the fact that how come all of a sudden the incomes are fluctuating so rapidly over the last 5 years. Yes, they could still see the fact that property is the profit share from the partnership, but then it still itches them to perhaps inquire and see whether they can find something more. So I wouldn't take things for granted. I mean, you would perhaps have an idea of what particular profit share, percentage share you would want to do in a long term. And you would perhaps play around and stick to that particular percentage share rather than just jumping volatilely from 1% to 99%. I think that just triggers and invites this invitation for more trouble from HMRC, I guess.
Yeah. No, I just need to check my understanding. It used to be the case that you could create a limited company and then you could form, a person could create a limited company and form a limited liability partnership with that company, one partner being themselves as an individual, the other entity being the limited company. Is that still the case, or is there some anti-avoidance legislation in there?
It could still be the case, but then eventually, yes, the answer would be, the question rather would be to your question is what you intend to do with it. So you have an LLP, one of the partner of the LLP is a limited company. Yes, it can be, and the other partner could be individual, which is fine, but then what you intend to achieve with it?
So it used to be used for company cars at some point, and I think they've done away with that.
It would make sense. Because a limited liability company is a separate legal entity, as we all know it. Say LLP has made a profit of 100 and the profit sharing is 50-50. 50 pound would go to that particular individual who is a partner, and 50 pound would go to the limited company as a profit from the LLP. And the limited company would then pay a further corporation tax on it.
Yeah.
So yeah, it's possible, of course, yes. But then obviously, if you have a name with keeping a name in mind, yes, it would be possible. But rather than that, I would go for the group structure where one entity is making a loss and the other one is making profits to offset the loss and profit against it. But yeah, it's doable.
Yeah, no, great. On your tax tips, you talked about the housewife. Obviously, that applies to the house husband as well, doesn't it? Just for equality purposes.
Unless if the house husband's name starts with D, then I've got my reservations for it. But yeah,
okay.
Other than that is fine.
That's fine unless your name starts with a D. Right. Okay. You did a really great illustration on trust. You had 3 acronyms: BRB, HRB, and ARB.
Yeah, so I mean, I had to, otherwise the space doesn't allow me. So because I've explained a lot about it earlier, because basic rate band, high rate band, and additional rate band. In a nutshell, basic rate band is income, a taxpayer whose income is below 50, a taxpayer whose income is above 50, and a taxpayer whose income is above 100. So yeah. All
right, and one last question from me, and it's quite an open one actually. What are the downsides of creating a trust?
I can't say any downside apart from the fact that you first answer the question of whether you need a trust, and you would definitely need a trust if you have a property which could be subject to inheritance tax. If you have done your estate, and if you do a calculation or an Excel spreadsheet of your property portfolio or of your estate as of now, which includes potentially could have properties within, you start with the fact that what if the worst were to happen now? So God forbid, if I were to be no longer today, what is my inheritance tax liability now? And that would give you a figure of what inheritance tax liability would be, whether it's 100K, 200K, 300K. And if there is an inheritance tax liability, then yes, you need trust, or you need some sort of tax planning to mitigate the inheritance tax. And trust is the most smarter way, I would say, to do the inheritance tax planning, because God forbid, tomorrow World War III were to happen, and I have had 3 properties, 2 of which I have settled into trust, and I have lost everything apart from these 2 properties which I have settled into trust. I can say, forget about everything. I don't want to save inheritance tax. Just give me my property back. I can dissolve the trust and take the properties back. That's the flexibility of having a trust, as opposed to giving the property outrightly to your son and daughter, only for them to understand, realize later that they have sold it, bought a Ferrari and went for holiday. So here with the trust, the reason why it says trust, because you trust that particular tool, and it is more flexible because you control over it as well as a trustee. So that's from the inheritance tax side of it. From the income tax side, like I've mentioned, any income earned by the trust, there is a potential to save complete taxation by having the dividend taxation planning. So in essence, you would not pay any income tax if you were to have trust, and none of my clients pay tax onto the income tax through using trust tax planning. And lastly, the capital gains tax, you don't have to worry about the Ramsey case of putting 20 hours, or if I'm putting 20 hours only, then I can create a trust. No, you can just put any property within the trust and you would get the capital gains tax holdover relief. That means you don't have to pay the capital gains tax on property that you transfer into trust. So I think it's a no-brainer. It's a win-win, yeah, not a win-win. It's just a win for the taxpayer. Unfortunately, it's not. It's a specialist in nature. It's very niche, and it's not so popular as the advisors would recommend the limited company, because there's more of forte of many advisors and many accountants. Trust is a very, very niche area, and not many specialize into, and hence the reason its hidden benefits and advantages are not being explored to the UK worldwide more.
Yeah, Arif, on your slide, I can't see all the letters behind your name.
Well, it doesn't matter as long as you know.
Yeah, I know there's loads of them. So, couple of questions.
Yeah, there was a bargain, so I thought I may as well go for 7 rather than just 1. So,
well, you know, I'm sure that, in fact, I know most of them are really hard earned. So, can I ask you to stay there for a minute? I'm going to bring Ranjit on and see if I can manage to get his slide shared.
Let me stop sharing now. I've stopped sharing. Yes, yeah.
First of all, thank you for your time. We're going to see if we've got more questions. If anybody's got more questions, please send them in. I want to give you a little break for a minute. So thank you for that presentation. Really, really great presentation. Maharajaji, over to you, sir. And if you can share your slides, you can have a couple of questions with Arif if you like.
How's that? Can you see the slide?
We definitely can, sir.
Oh, what did you do? I don't know.
I didn't do anything. I just made it happen.
Good afternoon, everybody. My name is Ranjit from Property Investor News. Going from the content this afternoon, it definitely shows that there's no secrets to success, or sex is no accident. I mean, success. Sorry about that. It's hard work, perseverance, learning, studying, attending events like these, sacrifice, and more. Remember, no pain, no gain. We have been publishing this for over 19 years, the magazine. Who is the magazine for? Investors, developers, traders, landlords, land buyers, tax experts, solicitors, accountants, surveyors, and the list goes on. Not forgetting party wall surveyors also. Why should you subscribe? 1, education and specialist knowledge. 2, information to weigh up the deals. 3, strategies so you could decide if it's right for you. 4, confidence to go forward in your business. Some key headline articles in our April 2021 issue, relevant to your property businesses and the changing and the challenging world. Opening comments from our editor, Richard Bowser. UK property market news. Landlord news, good, bad, and the ugly. This month we got an article, ugly one. Landlord fined £48,000. News analysis, house prices, development and planning news across UK towns and cities. Great tool for researching areas to invest in. News analysis, stock squeeze fuels rising rents. Research by Hamptons. Student accommodation, demand for student accommodation is rising fast. Will it last? Investor interview, local area focus by Richard Bowser, editor, Property Investor News, and a Kent-based developer, Peter Dabner. Staycation and holiday lets. Will 2021 be the year for staycation, or will it be soon be boarding planes? Commercial property, 5-step blueprint for adding value to your commercial property by Susie Carter. Auction Insight, the last 6 months and the next 6 months by Jay Howard, auction expert. Planning Matters, new permitted development rights by David Kemp, consultant and a barrister. News analysis, stores closed. Over 17,500 chain stores closed in 2020. Impact of the pandemic yet to be felt. Investor Opinion, Staycation and More by John Corey, Vector International Investor. Investor Opinion, Thoughts on Standing Out in Property by Helen Shawley, investor and former investment banker. European Worldwide News and much, much more. Subscribe to Property Investor News and read all the articles in greater depth and much, much more. Question for you to ask yourself that changes everything is, what is going well in my business? Question for you, do you have the expertise, the knowledge, the insight to adapt and prosper? Let us help you on your property journey, investing success. Subscribe today, ongoing education, in-depth market analysis every month. Access to online resourcing, 15,000 keyword search articles, 250 videos, plus webinar archives, and a hard copy delivered to your office or home every month for $7.95 a month. Because property investment and development is for the brave and the bold in these changing, challenging times. Therefore, we have put together a bold offer. Learn from the past, plan for the future. That's on the screen in front of you. It is an event offer only and not available online. So therefore, please follow the instructions on the screen. The offer is you'll receive 6 issues of Property Investor News, plus the book Before the Hammer Falls, written by 2 auction experts in the UK. All you do is go onto our website, subscribe, and then email me with your name, postal address, and the long reference number which the system will generate. Remember, the power to change life is in the simplest of choices. Every day you have a choice to stay the same or change for better. Why stay the same? Subscribe to Property Investor News. Stay on track with up-to-date information, specialist knowledge and education, and much, much more. The whole world is going through challenging times. Change is inevitable. Just remember, it's not the strongest nor the most intelligent survive. It is the most adaptable to change survive, full stop. So never, never stop learning, because life never, never stops teaching. Please remember, it's your life, your dream, your goals, and your business. Therefore, please do not let anybody hold you back. Subscribe to Property Investor News today. And lastly, just remember, no pressure, no diamonds. I will not hold you back any longer. Bobby, Simon, and Dill. Thank you.
Thank you very much. Can you do me one massive favor? Can you hold up the latest issue, please?
Latest issue. Yes, I can do that. It is on the background there.
Yeah, it's on the background. So I was going to say that slide is obviously me and Simon somewhere. Is the chap on that cover Bobby without his trousers on doing?
Do you want me to get up and prove it?
No, please stay seated, because we're going to get thrown off Facebook if we do that. So just to connect, if I could have my screen share back, please.
Yes, you can.
Thank you very much. That's the answer. So that's a great offer. And we were talking about new developers coming on board earlier. Any new developers, please subscribe. And I'm going to explain the reason why, because that's a fantastic offer. In January's issue, before it disappears off the offer, you'll find an article on party walls, especially talking about Section 1 of the Act. It's very important for developers building blocks. You can get rights to put scaffolding on the adjoining owner's land that the scaffolding license doesn't give you. And also, I've managed to do a really pretty picture of the party wall process there. So get the offer. It's all really great. Bobby, now that you promised to stay seated, have you got any questions for Arif before we let him go?
All good. You've actually answered all of them. So all good.
Arif, can I thank you very much for, first of all, taking the time out, and mostly doing a really great presentation with those fantastic slides.
Thank you all for giving opportunity as usual. So yeah, it's a pleasure.
No, it's our pleasure. It's really well illustrated, and you've obviously gone to a lot of time and trouble to put those together properly. Can I ask you one massive favor, if you don't mind?
Sure, sure.
Would you come back and do a presentation purely on trusts at some time in the future?
Yeah, I would love to. Yeah, so we'll just tailor-made it just for the inheritance tax and trust only, just for the trust side of it. Yeah.
Yeah, please, because that I think, as you said, it's a subject that not many people talk about.
That's a huge.
Probably because they're not actually qualified to talk about it.
No.
And they don't know their stuff. So it would really be great if you could come back on there.
Yeah.
They're not qualified to talk about it because they haven't got enough letters behind their names.
Oh no, you know, absolutely. There's only one guy I've seen with more letters than Arif, and he's not an accountant.
Is that right, Arif? How are you?
No comments. Ranjit, how are you?
I'm good.
So, gents, thank you very much for your time. I'm gonna, because I think I've run out of chocolate biscuits. I can't keep going anymore. I've run out of energy, so I'm gonna have a dose, another top-up dose. But listen, thank you very much. Really great show, folks. We'll see everybody. Don't forget, no program on Monday, 1st of the month. And next Thursday's program's at 5 o'clock.
5 p.m.
5 p.m. And Arif, you've promised to come back and do a presentation on trust.
Absolutely. Would love to. Would love to.
Brilliant. We look forward to it. And for all our viewers, thank you very much. June, thank you for that great message. Unfortunately, I can't answer it back on Zoom because I haven't worked out how to do it yet. But hopefully you all got some great value out of that show, and we'll see everybody next Thursday at 5 p.m. I'm going to be sitting here all week waiting for that show to start. Take care and listen.
At least go home and have a shower and come back.
No, I can't do that. Then I might be late for next week's show.
Because there's something smelling.
But listen, this is Zoom. It's not smelly vision yet. They haven't added the smell button yet. We can just about operate the slide share button. So to all our viewers, this is on Facebook. If you've got value out of this, and if you thought Arif's presentation was fantastic, please share it to all your friends. I'm sure they'll get great value out of this. So thank you very much for turning up today. We'll see everybody next week, 5 p.m.
Thank you all. Thanks.
Bye.
Nice one. Thank you.